All right, terrific. I think we're leveling off here on our participants logging in here. So welcome everyone to our webinar on Angel and Accelerator funding for university startups. I'm Kirsten Loita of OUP and I'll be your moderator today. For today's webinar, we will discuss models, structures, and best practices in raising pre-seed and seed funding for university startup companies from angels and accelerators. Our panel of experts will review their own models, which are distinct from each other in both the areas in which they invest, as well as the additional value they provide. I'm really thrilled to be joined by three fantastic seed and pre-seed investors. I'll have each of them introduce themselves now and tell us a little bit about their background. Later on, we'll go into the models that they're representing. So June, do you want to start us off?
Hi, everyone. Super happy to be here today. My name is June Axip. I'm Chief Science Officer and Partner at IndieBio. IndieBio is a startup accelerator. We're based in both San Francisco and New York, but also working virtually during the pandemic right now. And we've been around for 5 years. We funded 136 companies across all areas of biotech, from what we call planetary health to human health, so climate change related, as well as kind of the traditional therapeutics diagnostics that we think of as biotech. And our program is a 4-month program. We'll get into a little bit more. It comes with $250K in funding, and the program is very much structured to help scientists become entrepreneurs. So we kind of lovingly call it a entrepreneurial postdoc in some senses. And we do have applications open right now for our January program. So thank you so much for having me.
Great, so glad you are here. Ashok.
Hi, Kristen and everybody. Great to be here with you today. My name is Ashok, and I currently run an angel group, Tech Coast Angels, which is one of the bigger angel investing groups, and we'll talk about what that means in the country. My background is largely in entrepreneurship and social entrepreneurship myself. I've started several companies. I've sold a couple of them. I was doing angel investing when I connected with TCA and became the executive director a little over 4 years ago. I'm also pretty involved in the university innovation ecosystem here in San Diego, although I'm from Boston and moved from New York after spending 15 years there. And I've been in San Diego for 5 years, and I'm in EIR at UCSD and pretty active with the incubators and other programs at other schools like San Diego State. So connected with Kristen through one of our mutual friends and colleagues, the San Diego Innovation Council, and she was a judge in our pitch competition. It was virtual this year, called Inventors and Investors. And she said, well, we're doing a webinar actually, and it would be cool if you could come on. So that's how we connected recently. But that event was for funding university sort of spin out or originated, startups. So that's how, and that was only about a month ago. So here I am, and happy to talk more about what we do and learn more about you all today.
Yeah, and so glad you are here, and we'll be talking more about your networks and how to meet people later on in this webinar as well. So I'm glad you brought up that example. Serena.
Hi, I'm Serena Glover. Really glad to be here today. Kirsten and I know each other because we're on the University of Michigan's National Advisory Board for Tech Transfer out of the universities. So my first experience with startups was out of the University of Michigan. In fact, we were one of the very first licensees of software, tech transfer software out of Michigan back in the early 80s. So I was in the startup world in the 80s doing computer-aided software engineering. I was at Microsoft in the 90s running various product groups. And also I did some M&A. So I got a chance to see the buy side of sort of buying small companies, into a large company. And then in the not decade, I started a company, co-founded a company, and then we sold it to Nokia. So I spent a few years at Nokia learning mobile before Nokia went boom. And then I actually started angel investing in the mid 90s while I was still at Microsoft because there were a lot of people spinning out. I took a pause while I was doing my own company. But when I left Nokia in 2008, I started angel investing full time. I'm out in Seattle, and I mostly invest on the West Coast, and I focus on software technologies, mostly a little bit of hardware, but software, I don't do biotech and I don't do clean tech. So most of my examples today are going to come from the software tech space because that's what I know. So.
That's great. Thank you so much, Serena. And I actually like that each of our panelists has a different background, have invested in different areas. And so hopefully we can answer questions that are somewhat industry specific as well throughout the webinar. So thanks all for joining us here. For our audience, we encourage you to submit relevant questions throughout this webinar. If you would like to submit a question at any point, please use the Q&A feature on your toolbar. It's usually on the lower right-hand side. If you submitted a question ahead of the webinar, we should be addressing those as well. We actually have those, I think, on one of our last slides. And please note that the slides and a recording of this webinar will be available on our partner portal as well as our YouTube channel as well afterwards. So next, we're just going to show you a little bit about what our agenda is of things that we're going to be covering today. So first, we're going to have each of our panelists review their own models, which you'll discover are quite different from each other. But then we'll also be covering pre-seed and seed funding and what that means. So just to give a definition around that, timing and structures for those raises, how to meet with these types of investors that may be interested in your startup companies, the roles played by those investors, along with the mindset of those investors. And then we'll have a bunch of other questions that I'm sure are going to come up as well. So please do send in questions. I'll be looking those over and fitting them in as we can. But we're going to start off with each of our panelists here to talk about their models. So Serena, do you want to talk about individual angels and such as yourself and the practices that you have in investing?
Sure. So individual angels are a varied lot. We have as many different styles as there are angels. And there's no right or wrong in how angels invest. It's just everybody has their own thing. But the key thing to know is we are accredited investors. That's the SEC definition. That means we have enough funds in order to actually do investments in companies that are in a very high risk asset category. And we have a lot of different styles. So my style is I use portfolio theory, as do funds. So I look at it and say, I'm investing X amount of dollars over Y amount of time. And in order to mitigate risk and to manage risk, I have to invest in Z amount of companies. So I have to build a big enough portfolio to manage risk because the vast majority of early stage companies die. So I come at it from a very portfolio mindset, which is how funds, venture funds will come at it as well. The difference between somebody like me and a venture fund is a venture fund has a thesis. They're investing other people's money. I invest my own money. I have a thesis, but the thing is I can do whatever I want because it's my money. And so one of the problems, it's both a good thing and a bad thing because angels can get themselves in trouble because you can kind of do what you want. And so it's easy to kind of go astray. So, but I do try to manage to my own thesis. Now there's a lot of other angels out there who, Seattle, for example, has a lot of old Microsoft people kicking around that made a bunch of money early. And they may not have a portfolio theory. They just may be like, I'm going to write one check a year or maybe two, and I'm going to write it only for things I really care about. So they might have a technology they're interested in, or they might have an impact area that they're interested in. So they will look for companies that understand that space. So there's a lot of us. The key to remember is we're all different. We're all investing our own money. And we can be really flaky, but really helpful. And we'll get to that later because I think we're going to talk about how to think about which investors you should think about bringing on board. So if we don't, make sure we do cover that.
Okay. All right. And I'm just curious because you mentioned some investors, angel investors, maybe do 1 or 2 investments a year. How many do you typically make in a year? Do you have a target?
Yeah. So, my target original portfolio was I had X amount of dollars I was going to invest in at least 20 companies over the course of 2 or 3 years, because you have to have a minimum. And I do a whole class on this, like how to get started angel investing. You have to have, in my opinion, you have to have at least 20 companies in your portfolio. Otherwise the risk is just too great. So I'm always looking to expand, and I evergreen. So what I make out of the portfolio, I put back in. So I'm trying to do a fair number, 5-ish deals a year and kind of to keep that momentum going. But my initial tranche was I got to get to 20 deals in order to have reasonable risk mitigation.
Okay, great. Thank you so much. I'm sure we'll get more into structures a little bit about on the angel side as well as the structures for the fundraising of the companies, but that's helpful to know. So Ashok, angel funds.
Yeah, so Serena's a great example of, well, I'd call her a super angel. So it's someone who's, very experienced, very helpful, very active. There are groups, some of which have funds like Tech Coast Angels that kind of aggregate people like Serena. In the case of Tech Coast Angels San Diego, we have close to 250 members, and they all have, interesting background stories and reasons why they want to be angel investing. But by bringing the group together, we're able to increase and amplify the amount of capital that we can invest. So, instead of say the typical angel check might be $25,000 nationally, our typical round sizes are around $500,000 because we have dozens often of angels investing together in a single company. Because there's such a large number of angels in TCA, we actually started funds that are composed of the membership. So the way the funds work, and this is sort of a newer model, but the idea is the same as what Serena referenced, having a portfolio approach to angel investing, which is really key, and all the research shows that that's really the best way to go about it if you want to make money. So our funds are composed of the vast majority of our membership. We've had 3, so they've been annual funds, and we're on our 3rd one right now, which is $4.7 million that will invest over a 9 to 12 month period, and then we'll start the next one again. That's how our funds work. The upside for individual angels, the reason people participate in groups and in funds like ours, is that they're able to get that diversification in a sort of user-friendly way where they don't need to pick the 5 best companies that they see, because not everybody is capable of doing that or interested in doing that. The way, again, Serena's sort of a professional angel, but not everybody has that sophistication. So by being in an angel fund, we have members who just set and forget their angel investing. They make an investment of, let's say it's $50,000 at the beginning of the year, and that $50,000 is invested in 10 to 12 companies over the course of 9 to 12 months. So they get that diversification inherently by being in the fund. The great thing for companies is instead of having to herd the cats and get 10 people to write $225,000 checks, you get a single check from our fund for $250,000. So it's one cap table entry, which is good for sort of administrative efficiency, and you know how much you're going to get. So there's a few different tiers, and we have some kind of rules around the various investments from our fund. But at the end of the day, an entrepreneur knows if they come to Tech Coast Angels that from our fund, they're going to get a $200, $300, or $500,000 check. And that's in addition to any individual checks that they want to accept if they're also interested in individual checks. So the funds just kind of increase efficiency, I would say, for both the angel and the entrepreneur. And that's why we started them a few years ago. And they've really begun to dominate the operational investing activity at Tech Coast Angels.
And it sounds to me like the funds not only increase efficiency as far as perhaps putting all the dollars together, as you said, and putting one entry on the cap table, even though there are perhaps other individuals, investors coming in who've seen it, but also as far as people getting to know about the company and dispersing that to your network then.
Absolutely. And, I think one of the critiques you'll hear of angel groups like Tech Coast Angels, and it's a legitimate critique. And by the way, I raised money as an entrepreneur from angel groups. So I was on the other side of the table. But sometimes they take too long to make decisions, require too many meetings. You are trying to get awareness and attention from, let's say, 100 different people who all have different opinions. So you can imagine that can be a fairly unwieldy process to get to the finish line. And sometimes there is no finish line. So, in the case of our funds, we have a 30-day max due diligence period, and then there's a vote, period. So you're going to know a decision. It might not be yes, but you're going to know one way or the other within 30 days. And hopefully we'll be funding you. That's not always the case with angel groups. Sometimes they become a bridge to nowhere. So a lot of them are sort of restructuring their operations the way TCA did a few years ago to address those, those concerns from entrepreneurs, which are, very legitimate, as I said. But at the end of the day, this is a business, quote unquote, where you want to get access to the best companies. That's the only way that, you do your job and that you make money. As Serena said, most companies fail. That's the reality. It was the reality with most of the companies I started. But you have to get a few of them right, and that makes up for all the ones that fail. So as a angel group, your operations, your culture, your structure needs to be designed to attract the very best companies.
Great. And there are two questions that are actually addressed specifically to angel funds here that I'm going to ask you really quickly, Ashok, before we move on to June talking about incubators and accelerators. And we do have some other questions as well, by the way, from the audience, but they're actually things that we'll be talking about later. So I'm going to ask them then. But one is, Ashok, does TCA invest outside California?
Yes. So our focus is Southern California, and the Tech Coast Angels San Diego chapter focuses on San Diego, but we syndicate with groups, which includes other angel groups. It includes micro VCs. It includes super angels, people like Serena that are just doing this and kind of have a lot of deal flow, and they're very active themselves. In those cases, when we look outside of Southern California, we typically look for a lead investor who has done the due diligence. And the reason for that is, again, in the spirit of efficiency, we're just not able to properly review, source, diligence companies from all over the country because it's still a fairly small volunteer-led organization. So we rely on our partners to do the heavy lifting when we're kind of outside of our own backyard.
Okay, well, the next question kind of goes to that about the heavy lifting part. It says, is there an incentive for more active angels in the fund model where more work is actually done, actually investing by certain angels where others just invest and forget? Is there, I'm curious about, like if you have all these people involved with this, how that management of the work and then the active investing happens.
So there are groups that have extrinsic incentives. In other words, they will, for example, discount the dues or the fees, for people that are actively involved, or they'll require, points of stock shares from the company or options if they invest in the company based on the work, that those lead members are doing. We don't do those things at Tech Coast Angels. It's a kind of double-edged sword, and it's a sort of longer conversation. We can avoid going down that hole right now. But the bottom line is there's pros and cons, to having those kind of extrinsic rewards. I would say on the intrinsic side, because at the end of the day, there are groups of deal teams that lead every single deal that we do. And yes, we have to provide them support, and yes, we have to recruit those people for every deal, but we're fairly successful at doing that. So why would somebody spend that time versus kind of just being a freeloader and getting at the end of the day the same stake in the company? Well, there's a few reasons. I mean, one, the thing with angels, and I keep referencing Serena, but she's awesome. These are people who want to do this. They care about entrepreneurs. They've kind of been there, and they want to promote innovation in addition to making money. So there is a intrinsic reward in kind of helping entrepreneurs and the next generation of innovation. And then beyond that, by getting more access to the company and building relationships with management in follow-on rounds. So, let's say, one of these companies is a rocket ship and there's a limited allocation to invest in a future round. Well, who do you think is going to get first, look at that investment opportunity? It's going to be the, people that the entrepreneur has the best relationship with. They may also become part of the board or a board observer or an advisory board. So there can be other sort of rewards built into being a leader, in that deal team. So it's really a combination of, sort of just having people who want to stand side by side and be accessible to management, while also giving them, kind of additional access, especially if the company turns out to, be one of the winners.
Just one thing I want to kind of jump in and talk about a little bit, because like angels, the funds and the angel groups are all very different. Like Ashok's group is very proactive, does a lot of leading and so forth. Some of the ones up here, every fund up here, every angel group up here in Seattle is different. Some of them follow. So what happens is like people like me are involved in angel groups because it's great to be in an angel group, but we also operate independently. So we can do both. And so sometimes as a startup, you can come to an angel and they may bring you to a group. Like we have an angel group up here that follows. And so how we use that group is once we think we, you know, 2 or 3 of us have got a deal together, we'll go to that group and say, hey, can you guys fill out the rest? And we'll work really closely with them and help them with diligence and so on. And the flip is true too. Like if you go to an angel group, like a Shucks group, you're going to have independent angels in there who will invest independently as well. So there's a lot of synergy between going back and forth between angels and the various angel groups. The key is to understand the model, because every angel and every angel group works differently. So if you're approaching a group or an individual as a startup, you need to understand what is their model, how do they work? Like Ashok said, he's got specific timelines. Some groups don't. Having a timeline is good, right? Because then you know how long it's going to take. So understanding that's really important.
That's great. And actually it's interesting, Serena, because it goes well into June talking about their model at IndieBio, in part because before we actually started this webinar, June and Ashok were talking about a company that they both have invested in and worked with, because it was exactly because of these types of things where, you know, one of them had worked with the company, and then the company got to know others, and it's all about the people you get to know through this process. So June, do you want to talk about IndieBio and your model, and then just working with incubators and accelerators in general, because obviously there are a variety of models out there.
Yeah, absolutely. So like you said, incubators and accelerators are probably oftentimes used interchangeably, but there is a little bit of difference. Oftentimes incubators are more about a space and bringing people in. It's a little bit more free flowing and not on a exact timeline, whereas accelerators is more like a program. You know, ours is 4 months, others can be, you know, different amount of times, and there's a huge variety. You know, many people on this call are probably familiar with university incubators or accelerators, which, you know, have their own model and their own motivations tied to the university. There are non-for-profit ones, there are you know, for-profit ones, all over the place. For IndieBio ourselves, so we're just one model, and I would say that a lot of these accelerator and incubator models are experiments in themselves. There's no like sure way for them to succeed either, because they're all just trying to figure out how to get returns, or to, you know, help bring more companies into the world. So our model is we're a VC ourselves. Our VC parent is called SOSV. We have about $300 million in funding in our current fund, and it is deployed across about 7 accelerators all around the world. So we actually have one in Shenzhen called HAX that's hardware focused, etc. So we're mainly the biotech arm, and our model is around very much the portfolio approach, like Serena and Ashok talked about. It's as kind of any investor, you really want that portfolio approach. And for us, because we take a set amount of companies every 6 months, it really allows us to have a little bit more risk. So we've taken companies that just had pen and paper ideas, and we've taken companies that maybe have worked in academia for, you know, 7 years of a postdoc and finally spinning out and have papers behind it. So we purposely take kind of like different sectors, different maturity levels of these companies, but we do usually are the first check in. So sometimes the companies have maybe a little bit of angel funding or maybe a little bit of grant funding before, but we're usually the first check. And for that, we do take quite a bit of equity. Part of our value there is we also provide labs, which is something that is hard to get labs right out of school, or if you just have a pen and paper idea, you end up spending so much of your money into the lab. So we provide that lab, and it's a shared lab, and people come and work there. As you know, angels and VCs, everyone who invests in a company does provide mentorship and provide that connection. We do it in a little bit more of a hands-on way. We actually are with the companies every single day, usually in person, but now virtually. We're still interacting with the companies every single day. So the high touch nature and the nature of bringing in experts to give panels and also to connect mentors as the companies need them is part of our value, because what we aim to do at the end of the 4 months is to get these companies de-risking a big portion of their science, any like big questions that need to be de-risked for VCs to say, wow, this is actually real, figure out how the business works, figure out the models, try to get them to get letters of intent to validate their models and do all that experiment and customer discovery. But we also work on communication and figuring out how to package all this up to pitch to VCs. So the aim of the 4 months is to get them in front of VCs for their seed round, and hopefully they'll go off and raise $2 million or so.
Okay, great. And so we had a question directly for you, June, and then I have one for all of you before we go on to definitions of seed, pre-seed funding. You mentioned quite a bit of equity. What do you consider to be quite a bit? Are you allowed to say quite a bit of equity?
Yeah, absolutely.
So what kind of expectations, I guess, should companies have perhaps on this? And I know we're going to talk about this more on raises and structures, et cetera, but since you mentioned it.
Yeah, I'd say most accelerators are probably in, so we give 250K, which is relatively large, especially for, it's kind of needed for biotech, which is how we landed on that number. For that, we take, it's a convertible note, so it doesn't convert until your next round. So when it does convert, it's about 10 to 12%.
Okay, great. And the other question is actually for each of you that I wanted to ask right now, which is, of your portfolio, and this is if you know, of your portfolio, how many of those startups are university associated startups? And so, Serena, maybe I'll start with you. Do you know of the ones that you've invested in? How many of them?
Wow, I don't know that number off the top of my head because it's kind of a muddy question because. Well, first of all, I'll say there's pure tech transfer out of the university, and that's well defined. Like, okay, this company is going because of tech transfer out of the university. So I've got a couple of those, but there's a lot of companies that will have people coming out of, like, here it's UW, right? They'll be coming out of UW and they'll join up with some people who are not related to the university, but they're bringing technology and bringing ideas from the university. So university, that's why I'm on the tech transfer board with you, because I think like universities, whether it's pure tech transfer or it's just super smart people coming out with ideas, I mean, they have a massive impact on the startup world. And so I'm always looking at university technology.
Right. Yeah, it's some of it's kind of ecosystem, some of it's kind of through the traditional IP licensing, and there's just all these different ways that things are coming out. So it's yeah, I can understand
well,
how it's hard.
Just hiring, like my own startup in the not decade. I mean, we went to UW and just hired a bunch of kids that were still in school to code, and they were like awesome. And they ended up coming on full time after they graduated, and we took off. They joined us full time. So it was a great investment for us to hire kids out of the university.
Yeah.
And they taught us a lot because they were young and we were all, older and crustier, and they brought that fresh perspective. We should have listened to them more than we did, actually.
That's great. Ashok.
So similarly, the definition of university affiliated is, kind of a gray area. I would say in terms of, let's say, explicit, something that was spun out of through a tech transfer office, university, kind of originated company is probably in the 10% range, somewhere between 10 and 20%, I'd say. But then there's a lot of other, kind of university oriented companies that, including, for example, a member joining a startup, that group of students or researchers were working on before they even, kind of got to a commercialization, pathway, and then that becoming, a company that began at the university, kind of in terms of probably the ideation, but didn't necessarily go through a formal, transformation process.
Mm-hmm. Great, thanks. And June.
Yeah, for us, it's about probably 50% of technology coming out of universities. Since it's life sciences, it tends to need a little bit more IP before coming out. And then the other 50% of companies tend to be founded by people who've left university, worked in industry for a while, and then had an insight. We do have a lot of companies where the PIs themselves are advisors or co-founders on the company as well. But usually they take a slightly less equity because they're part-time, they're more advisors versus full-time members of the company.
Great, thanks. right, we're going to move on now to definitions. So the next slide. So what do we mean by pre-seed and seed funding and round sizes and et cetera? And Serena, we were going to have you start off talking about just giving people a general idea, especially because this seems to be a moving target these days. What do people mean by a pre-seed round versus a seed round versus later rounds?
Yeah, so the first thing, I guess, to know if you're thinking about this as a possible entrepreneur or an entrepreneur trying to figure out how to raise money is there is no set absolute definitions for this, and it moves all the time, as Kirsten said. So you'll hear terms like friend and family, you'll hear pre-seed, seed, seed one, seed two, institutional seed, and they all have slightly different meanings, but there's no like hard definition or hard dollar amount. It depends on what city you're in. It depends on what industry you're in. Like June said earlier, you know, biotech and hardware is another example, often takes more money early than say software tech does. And so it depends on the industry, but typically in general, what you'll hear is friends and family are those really early rounds where you'll go out and you'll get Uncle Billy Bob and Grandma Sue, and they'll put money into your company and maybe one of your best friends from college. And you might, and I'm going to give you a software tech example, okay, because it'll be different for biotech and hardware, but you might raise 500K or 250. It's going to be a smallish number, maybe a little bit more than that. And that might get you going. That might get your prototype built. It might get you off of the napkin, so to speak. And then you might go and you might raise, well, it used to be a seed round. And then what happened, at least in Seattle, is you just didn't raise one seed round. You had to raise many in order to get to an A, because an A is the real first, Series A is the really first growth round where you got to be on a curve and people have to believe you're on a curve to invest in it to get an A. And it's harder and harder to get an A. So what's happening is more and more seed rounds are having to happen to get there, at least in some cities. Now, in places like the Bay Area, the velocity is way faster, but up here, it's often multiple rounds. And so now this new term pre-seed has come in. And that didn't exist, I don't know, a couple, 3 years ago, at least up here. And now all of a sudden it's a big term. But what I'll say is that in general, if you're raising between 250 and, you know, maybe a couple million or a little bit more, maybe if you're in hardware or biotech, you're in the seed range. And what you call that round will depend on what industry you're in, where you're located, what you've already raised, and how much more you think you're going to need to get to A metrics. And so that whole process of what do you call it is very specific to where you are geographically and how much you're raising and how much more you think you're going to need. There's no set definition.
That's really helpful. And I was curious actually from Ashok, you know, you at Tech Coast Angels, you invest in a variety of industry areas. You know, what are you seeing? Especially, I mean, you concentrate obviously, you know, kind of in the Southern California area, but what are you seeing as far as differences in industry areas across these pre-seed, seed, later stage rounds?
Yeah, so you know, like you both said, it really is a moving target that can go, you know, up or down in terms of smaller, bigger, you know, more money, less money. One of the very clear patterns in, let's say, the past few years is what I call seed as a spectrum, where the seed round that maybe, you know, 5 years ago used to be a single, let's call it $500,000, $750,000 investment, is now tranched into 2 or 3 separate slices, you know, but maybe the first one might be in that smaller, you know, call it $500,000 or so range. That's especially if a company doesn't go through an accelerator program like IndieBio. Programs like IndieBio will often cover a lot of that initial, you know, seed, you know, kind of fundraising. But let's say a company is raising on its own, or even maybe if they've gone through a program, they do one raise, then they hit some milestones, do a second follow-up, you know, really seed extension, it may be called, or bridge round raise, and then maybe even a third that continues kind of, you know, down that spectrum. So that's been a very clear pattern going on in the last few years. I think for an angel group like TCA, what's the implications there? Well, one, we invest more and more downstream. So there was a time when, you know, Tech Coast Angels of the world were focusing on, you know, sort of pre-product, you know, very early what today you'd call pre-seed companies, and now our focus is more on these later stage seed companies and even Series A rounds or these bridges to Series A rounds. I mean, we have definitely shifted downstream, meaning further, along in a company's life cycle in our investment activity over the past, I'd say, 18 months.
Okay. And actually, one of the questions that came in actually was asking about, for example, a lot of these funds, these angel funds have kind of these fixed funding amounts, or maybe this range you mentioned of like $200,000 to $500,000 per company. Does Tech Coast Angels have a vehicle for follow-on rounds, either in the fund itself or among the individuals who are part of the fund? Because that's, I think, been one of the critiques in the past about funds of angel groups is not having that ability for kind of that long-term support.
So the answer is yes to both. So specifically within our
Okay.
funds, there is the facility for a then active annual fund to make an investment in a company that, let's say, the prior or one of the prior annual funds invested in. We have some administrative, processes for that, but it is absolutely accounted for, and we have absolutely done follow-on rounds even within our three funds. There are also many follow-on investments that take place from individuals who have participated in prior either fund and individual investments. I'd say as a company, one of the best ways to ensure that happens, besides hopefully hitting your milestones, is communicating to your investors through investor reports on a regular basis, because you don't want the first time for you to have a conversation after investing to be you're running out of money 7 months later. It's a good practice to have a regular cadence of investor updates, so then investors are aware that there's a new potential funding capital injection sought, and they feel like there's a trust and transparency built in, and they're kind of along for the ride in knowing the ups and downs, which everyone understands there's going to be both. So they're more apt to participate in that follow-on opportunity.
Great, good to know. And then, Serena, I know you had already mentioned a bit about milestones and, what people are funding towards, et cetera. And I was actually going to ask June then about at IndieBio, when you're investing, I think you're usually investing towards the company, getting to a certain place. What are the milestones that your companies are typically heading towards, since you're focused more on a specific sector, although there's actually a number of subsectors within that? Because I know this is a hard question to answer broadly. So I thought I might ask you this one, just since you're at least focused on the biotech sector.
Yeah, it definitely depends on the individual company and what they're looking for. So, if it's a therapeutics company, depending on where they come in, do they already have in vitro, in vivo data, and you kind of go towards the next thing, or prove out the safety and efficacy on usually in vivo models. If it's a consumer company, then we want them to start selling things as soon as possible and get that feedback so that they can start iterating on their product. I think, yeah, so we are considered pre-seed, and we give the 250K, and sometimes that's enough, sometimes that's not for some of the companies, and some might supplement with additional angel funding or other types of early checks. But then most of our companies were aiming for that seed round. It's been around between $1 to $6 million for like a biotech seed round, with an average about $2.5 million is what we've seen in our rounds. And then the later round would then be a Series A. I agree with the other panelists that very much we're seeing a lot of people doing bridge rounds. And I guess one thing just to kind of frame this as well is that it's really about what you want to do with that money, right? And how you pitch for that money. Usually people for a seed round, they're looking for 18 months of runway. And then usually you want to, plus 50% more just as buffer. And then you really have to think about like, what is, like Serena said, like, what are Series A investors looking for? What kind of milestones do you need to hit to kind of start that growth trajectory? And so figuring out how much money you need to budget to actually get there. So I think that's a lot of the calculation of a founder, because you also don't want to take, like, if you can accomplish what you want to accomplish in $2 million, you also don't want to take $5 million because you're giving away so much of your company at this point. So you want to find the leaps where basically the minimum amount of money that you need to accomplish that milestone so that you can then make that next leap.
That's helpful. And we had one other question. Oh, I'm sorry, Serena, you wanted to jump in. Go.
Yeah, I just want to jump in because June just hit like one of the key critical things for CEOs to understand, which is when you are raising money, you have to raise enough, and usually it's 18 months, so that you're not always in fundraising mode, because then you can't run your business. And you always have to be thinking about what you're raising now is not about now. It's about what do I need to do to get my next round? Like, what metrics do I have to hit to get my next round? How much is that going to take? And of course, like June said, add 50% because shit happens and you're always going to need more money than you think you're going to need. So that is like the most important thing that anybody said on this whole call so far, is what June just said about how to think about money. And it'll be totally different depending on where you're at geographically, what stage you're in of the pre-seed, what industry you're in, and so on. That dollar amount will vary. But that's a really critical thing for investors or CEOs to understand.
Thanks, Serena. I think another important thing that is going to be, that we're going to talk about a bit more later, but we have a little bit of here is why are angels doing what they're doing? And a lot of that has to do with the return on investment. And so I would like for each of you to just talk really quickly, what is your kind of expected return for your investment? And Ashok, why don't we start with you?
So from a fund perspective, a 3x return on the fund, cash on cash, meaning the investor gets back 3 times their money, is definitely a target. The vast majority of funds don't return 3x, they return 1x or less. Many are sort of between 2 and 3x, and the very, very, very best ones that are the household names return, much more than 3x. But 3x is a good benchmark. If you are able to achieve that, you're going to generally have happy investors.
Yeah, and that's across the fund, though, right? And so when you're actually making the investment, what are you targeting for a particular investment?
Right. So the 3x is the aggregate for the lifespan of the fund. Since most of the companies will either fail completely or maybe return some of the money back, that means in order to hit the 3x benchmark, you have to have a few companies that are basically returning, the entire fund or close to that, which, are 10x plus companies. So really the portfolio theory here is they all need to be in the 10x, range in order for you to actually end up with a few that hit that mark. So generally we're looking for, 10x plus exit opportunities, unless there's a nuance. And again, for individual angels that can take their own idiosyncratic risk, there are cases, and this is where sometimes that scenario that Serena alluded to, where maybe a few people pull a deal out of a group because, they have a specific interest in that company. It may be a different hurdle rate than the group, but as a group, let's talk, kind of in general, we're looking for 10x plus opportunities, and that's every venture investor basically.
Right. Yeah. Serena, and
Yeah.
different?
Yeah, that's totally true. It's how I think about it. I'm in the hits business. So when I'm looking at your company, I'm looking at it through the lens of, can this be a 10Xer? Can this be a hit? Because I got to get one of those in a portfolio of 20 in order to make the math work. And so that is exactly, but a lot of angels though, that are just doing 1 or 2 deals a year, they're not really thinking about returns that way. They're more thinking about personal impact and personal interest. So not every angel will be looking at that math. They'll be more looking at, is this cool? Is this something I want to be involved in and work on and help? Or do I think this will have some other impact beyond just monetary impact? And we can talk about that because, I look double bottom line at all my companies now. So, but I still do have that math behind all the investments.
Mm-hmm. Great, thanks. And June, anything different? And I also have another quick question for you.
Yep. It's very similar. Definitely looking at kind of the math. I think with our system, because we are doing so much training on the companies too, like we can take a little bit more risk on companies that maybe have not started yet or have different things. But what we do want to make sure is that the market is there, so that if this company were successful, if all the technology works, that they have something big on the other side. And for biotech, because the timelines are a little bit more stretched than some of the software companies, we're looking more like a 10-year fund.
Okay. And one of the other questions that came in was just about when companies are accepted to IndieBio, do they have to locate to the incubator, or can they stay remote?
Yeah, previously in the before times, we did require relocation to San Francisco because there's a lot of advantages of being in San Francisco. And also, I think our model works really well when we're with them in the lab and get to interact with them every day. We have, of course, adapted into a more virtual environment now. So now it is virtual, but we still have that level of engagement via Slack and chat channels.
Yeah. There was another question for you, June, about if a $2.5 million investment is made, how much equity would actually be received for that? I mean, I think you had talked about that a little bit beforehand, but is there any update on?
So 2.5 for like a seed round after. I think usually I think about like 20% is probably average. Yeah.
Right. And then, so Serena, you had mentioned about, you want to ask for 50% perhaps above what, you think you probably need. When a startup goes out and asks you for that, are they providing justifications for that? Or do you understand that as an investor that, you don't want to just see them basically meet their costs, but they need to be, that they are anticipating that things don't always go exactly as planned.
Yeah, I mean, the key thing on at least what angels are looking for, what I look for, and again, everybody's different, so I'm just telling you kind of from my perspective, but what I'm looking for is, do you, CEO, understand what metrics you need to hit to get this business off the ground? And those metrics are different for every business model, for every technology, for every industry. But for what you are doing, the play that you are making, do you understand what you need to hit? And then the question is, do you have a thesis on how to get there? And this is one of the things that's really, really critical for CEOs to understand, and especially women, because women tend to be like, if I don't know everything, I'm not going to say anything or do anything. I have to figure everything out first. Whereas guys, so they'll be like, I got to have 100% of it figured out to even go ask for money. Whereas guys will be, and I'm generalizing, but there's some truth in this. Guys will know 20% of what they need to do, and they'll just go out and ask everybody for money. So the key is not knowing all the answers. The key is knowing what questions you're going to ask or what experiments you're going to run, because it's all about running experiments, whether you're testing product and product features or deep technology, or whether you're testing go-to-market strategies. It's about experiments. So what experiments are you going to run? What are you trying to get to? And what questions do you need to answer? And then I will look at it and go, okay, do they have some clue as to what that's really going to cost? Like, for example, consumer, super expensive marketing, right? Can be very, very expensive to market. Do they understand that? If they're deep tech to government, do they really understand it takes, a year to a year and a half to get a contract? And is there a way in the short term to get some feedback on the technology without waiting a year and a half to get a government contract? So there's all those kinds of things that I look at when somebody says, I need to raise $1.5 million. It's like, okay, what questions are you going to answer with that? How do you think you're going to try to get to those questions? What experiments are you going to run? That's what I look for.
Great. I'm going to move us on to raise timing because we only have about 40 minutes left, and we have a lot of questions, but also a lot of things that we said we were going to get accomplished in this webinar. So let's move on to raise timing, and just have each of you talk about what you advise people when they're looking to raise, about how they're actually timing that raise. And June, I'm going to start with you on this one, what you're advising the companies that you see.
Well, for coming into IndieBio, we're a little bit different because we have batches, and it's twice a year. So basically, but we do have a rolling application. So we will like talk with companies whenever, and then kind of if things line up, then we put them into one of our batches. We do see for timing wise, the seasonality, Thanksgiving, Christmas is definitely a little bit of a dead zone. The high vacation times in the summer are a little bit slow as well for VC firms to come together for all their partners to make decisions. Although during COVID, I'm not sure if that's a huge issue or not. We've actually seen quite a lot of activity during the pandemic because everyone's glued to their laptops and able to get on calls very easily. We do recommend companies, so it depends on what stage you're at, but if you're like a pre-seed seed company, you definitely want to start having conversations probably like 6 months in advance. As a pre-seed stage, maybe 2 months in advance from your drop dead date. So that's something that we track with our companies when they come in. We definitely survive hopefully survive another couple months after leaving us. But that is also taken into account people's burn rates. And if their burn is super high, then we will advise companies to bring in some angel checks to help them get over the curve, or to seriously consider a real raise. And especially depending on how where they are in their traction and in their science, are they ready to fully do that full raise, or do they have to do that bridge round?
Great, thanks, June. Serena?
So for at least with angels, there is a bit of seasonality. It's like June said, summer, we all disappear. Between Thanksgiving and Christmas, forget it. So really your seasons to raise are like mid-January to early June, and then mid-September to Thanksgiving. Those are your windows for angels to be sure you're going to get them. Unless it's your first round, of course, where you're raising your first money, you don't want to be raising on an empty bank account, because then people will just hold you hostage and to help drive your valuations down. So the worst thing you can do is raise a bunch of money, clump along and ignore fundraising, and then all of a sudden go, oh, whoops, I'm out of money, I need to go raise again. That is like a recipe for disaster. So you need to be raising way in advance of your bank account running out. The other thing is because I teach a fundraising class, it's like people don't understand prep time. It takes longer to prep for a raise and get everything together than it does to actually raise often. So, and people underestimate how much time it takes to get ready to do a raise. And it takes a while to pitch too. Now it depends. It's kind of binary. You're either one of those people that happen to be in the right city, SF, you went to the right school, you have the right network, and you can sit down in 2 weekends in coffee shops and raise $5 million or raise $3 million. There are those that succeed in doing that. But the vast majority of startups take a long time to raise money. And like June said, I mean, I say a minimum 6 months and usually longer that you should be preparing, getting your materials together, warming up investors and stuff before you hit it hard. And once you do hit it, it's a full-time job. So that's why it's great to have co-founders who can kind of keep the company running while you're off raising money.
Great, thanks. Ashok, anything you wanted to add on raise timing that you're seeing?
Yeah, well, I think the bases were largely covered. I'll just add that going back to the fund portfolio theory, and let's say pitching to a group or a firm or even individuals with multiple funds, you might also consider the composition of the particular fund that is currently open or that might be open in 6 months from now. So in other words, there's a scenario where Angel X doesn't want to invest in your company because she just made a investment in a competing company in that same fund that they're using right now. Now, there's also a scenario in that same situation where maybe they want to double down because they love the space. But you do need to consider the diversification goals for a particular fund as part of that timing. It could be that the timing either being a little bit later, a little bit earlier, could have implications toward their portfolio theory.
Great, thanks. So we're going to move on to structure. We have a lot of questions that have come in, and what we're going to do is we're going to go through structure and how you've sourced your opportunities, et cetera. And then we're going to probably just do Ashok had suggested doing a lightning round on the questions that we've been getting in, and just kind of posing them to each one of you for those that we haven't gotten to yet. So, but because I really want to get to all the questions that have been coming in, but we have a lot of them. Also, I want to get to some of this kind of basics information as well. So let's talk about structure of how these pre-seed and seed rounds work themselves. So Serena, could you talk about what is a note versus a safe versus a priced round, and how each of those work, since those are often things that we're hearing about with regards to pre-seed and seed investments.
Right. Yeah, and I'll do this very quickly because I know we're running out of time and we could talk for a long time on this, but very, very quickly, notes are debt. It's basically you're borrowing money from an investor. And as June said earlier, that note will convert to priced stock later on. Usually it's Series A. So a note is debt. They're simple instruments to execute. They don't cost very much, and they're easy. They basically have a cap which says, you know, you'll convert at no more than a certain price point. They'll usually have a discount, but they're very simple and easy to do, which is why early stage companies do them. Because if you try to price around early on, pricing stock in a company is much, much more expensive. It takes a lot more paperwork and a lot more effort to do that. So typically, startups will use notes or safes. A safe is not debt. A safe is a warrant. It's actually considered equity. It goes onto the cap table as equity, but it's essentially a warrant. It's the ability to buy the stock at a future point in time at a future price, at a price. And they have caps and discounts and all that stuff as well. The difference between notes and safes, they're both simple instruments to use. From an investor point of view, the thing to understand is safes, because they're equity, they start the QSBS clock. There's this thing called the Qualified Small Business Stock, I don't know, Act or whatever it is, that allows investors to get discounts on taxes later on, or to delay taxes on capital gains, depending on if they're early in a company and how long they've held that company and so on. So no time to explain QSBS here, but just know that term and know that that is what will drive some early stage investors to say, I'd rather have a safe than a note. But there's downsides to safe from the investor perspective as well. So that's a whole, we could talk for half an hour about the difference between notes and safes, but just know that safes and notes are much easier to execute, much cheaper to execute, and price rounds cost more. And you usually don't see priced rounds, at least in software tech, until Series A.
That's helpful. And we talked earlier about the equity stake that often you're seeing in a seed round. Often it's around 20%. I don't know if any of you wanted to add anything on to that's, you know, whether you see things that are vastly different from that. Serena.
Yeah, so what I advise early stage, and again, this is software tech, so it might have a little bit different dynamics than like some of the other areas, but the whole goal is you want your founder or your founding team to be able to get through all the rounds they need to get through and still have enough of the company to make it worth their while. So it's not always to the advantage of the investor to get the biggest chunk possible and to push down the employees. It's actually the opposite. And some investors don't think about that right. They're just like, I want the cheapest valuation possible. I'm like, well, that's not really necessarily what you want. You want to make sure that as they get through this, that they're going to end up with a big enough chunk to want to keep doing it. And so typically in an early round, you know, 20, max 30% giveaway of the company. And then as you go forward, you give away less and less and less with each round because the valuations will go up. And so, but that's ballparky what I tend to see. And you have to be really careful as an investor to not demand more than that, because otherwise you'll just run them into the ground and it leaves no space on the cap table for them to raise the right kinds of money later on.
Right. All right, we're at 10, well, in Pacific time, 10:01. We have 29 minutes left of this webinar. Still have a lot to get through. Ashok, do you really want to do you want to go quickly through a valuation example, just because we get a lot of questions about valuation and how that works and who sets that pre-money valuation and how pre-money versus post-money works?
Yeah, so just in the simplest terms on pre versus post money, the pre-money valuation of your company is, what, let's say you think it's worth, and just valuation in general is a market function. So the value of your company, it's not a public company, is basically what people are willing to invest in, the terms. That's the valuation of your company, because there is no, direct, kind of model that you can use. So the pre-money valuation is the valuation of your company proposed, let's say, before you bring in money. Let's say it's a 4 million pre and you go and raise $1 million, then your post money valuation is going to be 4 plus 1 million. So that's $5 million. The implications for founders are you have to consider, and your investors surely will, the equity that's left to you as the team and the investors, both from a pre and post money valuation perspective. Obviously, a low pre-money could be very different from a post-money valuation if, let's say, a company is raising $10 million. So if the investors own 10% of the company, at the pre-money valuation, then it's going to be a different, lesser amount at the post-money valuation. So it's just a equation that you have to consider when you're out fundraising and you say, this is my proposed valuation. Be clear on whether that's the pre, or if it's a cap, which applies to convertible notes, or if it's more what you expect in the post-money valuation. It's such a complicated cap table computation when you get into the weeds. I'll stop there for now, but that's what lawyers are for too, and it really can get complicated when you factor in a lot of other things that I didn't even get into right now.
And I'm going to back up just a little bit here too. Then, when you're actually, talking with an investor, how are the terms arrived at for that early investing round? That's something that's one of our people, one of our audience members asked about. Does the company initially propose those set of terms, but do they try to, or how does it end up working actually functionally when there becomes interest between the parties?
So there could be cases where the investor is largely standardizing the terms. A lot of accelerators operate that way. They have a model where they invest, say, $125,000 at a, basically $2.5 million, let's say, valuation. And if you want to be in the program, you accept those terms. That's how a lot of them work. Generally, I would go back to what I said before. The valuation is a market supply and demand function. So yes, often entrepreneurs will propose a valuation, and now let's say we're talking the first round of financing where there's not a benchmark to look at from prior rounds. The entrepreneur, the company may propose certain terms, but at the end of the day, she who has the gold makes the rules. It's the golden rule. So the actual terms will be set by the lead investor in that round, and then other investors, let's say followers, will be investing typically at the same terms that lead investor set. The lead and the company will have a negotiation to determine not only the price, but there's a number of other control, let's say, mechanisms in a term sheet that hopefully is fair for both sides. And I think that's a really important thing. And Serena touched on that. You don't want companies that are stressed about survival from day one. That's probably not going to result in a successful company, and nobody wins. So it is important, I think, to be fair and reasonable on both sides of the table. And a lot of the, at least, parameters are largely kind of set by the market, whether you go by a multiple on the monthly recurring revenue if a company's a little further along, or the regulatory stage that they're at. If it's a drug development company, let's say, there are at least some references that you can draw upon.
Great. All right, we're going to go on to the next slide, which is about investor mindset. So again, learning a little bit more about you and what it is that you're thinking at. What are you particularly looking to achieve? I think we actually covered most of that, when you talked about your models in particular, but maybe you could talk a bit about what do good pre-seed and seed fund investors actually do for the companies, other than, of course, giving them money. And June, maybe I'll start off with you, just because you talked a little bit about what IndieBio does, but a little bit more about what is a good incubator or accelerator going to do for that company?
Yeah, absolutely. And extracting to VCs in general, kind of Ashok mentioned, you know, a lot of it is based on a lot of times these folks that you bring on are ends up on your board of directors, and so they are going to be with you forever. And that's actually in general, these investors are with you, and they're there to help you, and you're kind of, it's a partnership together. Very much like founder relationships. So picking your investors is really, really important, because you know, the investors will kind of shape where the company goes, bring in, you know, have their opinions on things. You definitely want to look for investors who are knowledgeable in the space that you're working in, who have maybe invested in things that are in a similar sector, so that they also have the connection and network to support you. Oftentimes, you know, a single investor alone will not be able to fund a whole company, so they need to bring in their friends, and they need to know who else can co-invest in. So looking at what a VC, who a VC also co-invests in, can also help understand like how that ecosystem works. And so, yeah, I think investors, you know, not only do kind of like the big directional thing, open up doors, but even things like hiring, you know, they have a network of people, and eventually, as you grow, you're going to be hiring potentially more senior people to bring in different operations of your company. And for investors who have that network and can bring in new people from different areas, would be really important too. So yeah, I think, you know, every investor, take a look at like their sector, how you jive with the investor in general, because at the end of the day, it's also a personality thing, and communications thing, and just rapport. Yeah.
And actually, there was a question that someone had about this, about how do you actually target in angel investors based on their specific interests? Are there certain communities that are friendlier to certain areas? How do you find out this information, you know, on specific interests? Is there a good website to go to, a good database?
Is that for me? I think for
sure. Why don't we start with you, and maybe well, it sounds like Ashok has a good answer too. So.
Yeah, I think scouring the web is definitely very helpful. Events in the in-person times is definitely like probably my number one thing, is because you definitely have like-minded people going out to similar types of events. So just networking. Cold emails actually are surprisingly useful, and especially during COVID, I think a lot of people are answering cold emails more readily. So basically internet stalking. And if you can say like, oh, I've seen you invest in X, Y, and Z types of companies, you might be interested in my company, and you know, here's how I'm different, here's how I'm awesome. That can really that can open up the door for a conversation.
I couldn't agree more with that, because you know, we get so many cold emails, but a lot of them show they don't know what our fund thesis is, or they don't seem personalized, et cetera. But when they're personalized and they say, well, if this is how it fits into your fund thesis, and you know, you've invested in similar companies, I'm like, okay, this person is actually really talking to me. They're not talking to some robot. So a shock.
So, like finding a partner in life, you know, you network, as June mentioned, which could be events, it could be, you know, apps. Like AngelList is one that has a pretty big database of, you know, individual angels, or, you know, LinkedIn, you can search by filters like angel investor. You may or may not find the people that you're looking for, and obviously that's a buckshot type of approach. But I think it is an important point that, you know, June you know, just emphasized, that most of these investor groups or firms do have websites. And unlike finding a spouse or partner, you actually can go to the websites by doing your research on, let's say, the vertical theme that your company's focused on, and probably submit a application or a email to the contact form. And as long as you do make it personalized and relevant, and show that you did a little bit of homework, you know, as Kristen said, there's a good chance they're going to respond to you. I mean, I could say for certain at Tech Coast Angels, assuming you did the most basic level of homework, meaning you're not a coffee shop pitching Tech Coast Angels, we're going to respond to you one way or the other. And that's our obligation, to do that. That's part of being in this business is, understanding that opportunities can come from all over, and we want to be open to any opportunities.
Serena, I'd love to ask you the next question, which is how do you get comfortable with the company and the people in which you're making an investment? How do you get beyond saying no? What's the diligence that you're doing so that the companies understand what it is that you're actually looking into when you're making those decisions to make an investment?
Yeah, well, the first thing that's really important for CEOs to understand is most investors, when you come to pitch to them, first, totally second what Ashok and June said, which is you have to do your homework beforehand. That's why I say prepping for pitching takes a long time, more than you think, because you got to know who's sitting across the table from you and what their style is and what they invest in. And you can find all that stuff if you dig around the web and look on LinkedIn. And when you meet with people, ask the next person, I always ask them, who else should I talk to? That's how you find more investors. But when you get in front of somebody like me, the first thing you have to understand is we're going to put you in a box. Like the first words out of your mouth about what you're doing, we're going to be like going, okay, what is this thing? What's it like? Is it a this? Is it a that? Is it a software thing? Is it hardware? Is it, and we'll put you in a box. And it's like, you have to be really, really, really careful, especially if you're doing like deep tech stuff out of a university, that you explain things really, really clearly. So it's the whole, what is the problem I'm trying to solve? What's the solution I'm building? And how big can this be? If you don't get that right, I'm going to put you in the wrong box, and it's just going to be really hard to get you out of that box, and it'll probably be a no. So if you get into the right box and it's like, oh, I get what you're doing. Ooh, I'm interested. This looks big. Then I'm looking for, in the really, really early stage, I'm looking a lot at, okay, is this a space I'm interested in? Do I believe this is big enough? And this is where you got to swing for the fences. And that's a mistake that some companies make, because they think, oh, it's hard to raise money, so I'm going to be really small. You have to really explain what's the big play. And then you got to explain to me, what are the steps you're going to take to get there? And those steps will be incremental. It's like you can't build everything at once. So it's like there's a big play, and then I got to believe you know how to stepwise get there. It's like, this is what we're going to build first, or this is what we're going to do on go-to-market first. And I'm really, really looking hard early on at, do you understand your business? Do you understand the play that you're making that will make you competitive, will build the moat? Do you have some common sense about how to get there? Do you really understand the metrics of your business? Like, can you describe to me, what are the metrics that are most important to drive this business forward? And those are the things that I'm looking for, in early companies the most. Like, can the CEO, because ultimately at the end of the day, the CEO is a storyteller, and you're going to be selling and selling and selling forever. Like somebody said, it's a business relationship. It's going to last forever. You're going to have to sell to investors. You're going to have to sell to your employees, to the press. Can you tell that story? And can you clearly articulate what you're doing? That's what I look for.
That's really helpful. Great. We're going to move on to the next slide, because we have 15 minutes left, and I want to get through these next two slides, and then we're going to go into all the rest of the questions and kind of go through those quickly with you. And this is basically for companies themselves, finding their investors, and going actually to how you source finding your investments as well. So, quickly, I'd like each of you to talk about how you source your investments. June?
We have an application online, so we do funnel people through that, but we go out, and so conferences, giving talks, just everywhere we can. We go find lists from like the IP transfer offices, from academia and news articles, everything. So yeah.
Okay, great. Serena?
For me, I've been in this ecosystem for a very long time, so mostly it just comes to me because I've been around for a long time. But the thing I would say to CEOs to watch out for with angels, especially early angels, is try to find people who understand your space. because what can happen is you can get somebody really excited about your company early on who doesn't really understand your space, and they can give you really bad advice. So you have to be really, really careful. Not every check is equal. And you might take money from people who don't understand your space, but you need to know that they don't understand your space, and be careful of the feedback that you get. The classic example in Seattle of this is we are an enterprise town because, a lot of us came out of Microsoft. We understand enterprise. And if you try to run a consumer business in this town and you go to early stage angels here, a lot of them came out of Microsoft and deep tech, they're probably not going to give you the best advice on how to launch a consumer brand. And we see that all the time here. So be very careful about who you pick.
Great, thanks. Ashok.
Yeah, so certainly network and brand, are two of the primary, drivers of deal flow. But then I think relationships and referrals is, another one. So that's referrals from founders that we invested in. That's referrals from members, in the group from TCA. That's where probably the majority of our deal flow comes from. And it's referrals from other investors, including, angel groups or, super angels around the country, and programs and venture firms like IndieBio who will share deals with us just the same way that we will share deals with them. So at the end of the day, it really comes down to relationships, and that's why as an investor, your social capital is really a major indicator of probably the financial capital you'll eventually be able to generate.
And I'm curious, actually, I'm going to go in reverse order now. So Ashok, I'm going to start with you, but, and I'm going to ask both of these questions at once. Where should company go in normal times to meet investors? And what are you finding as differences during the pandemic? And then I have a follow-up question for each of you on this. So.
Well, so in normal times, I would start local, since for many investors, especially at the angel stage, there is a human touch that is sought by both parties. So the team is looking for help in hiring and other kind of technical assistance, and the individual angels looking to make a difference in their community. So any of those local ecosystem kind of events and programs are a good place to get started. That obviously has been altered for COVID times. The virtual versions of those platforms are generally now up and running, so still tap into those networks. But the virtual versions, I mentioned that we met Kristen when we ran a virtual version of our pitch event a few months ago. So those opportunities still exist, and that was for San Diego, focused on, let's say, San Diego companies. In addition, I think you can expand your hook and line a little bit more because of the virtualization of kind of the investing universe right now, and be a little bit more ambitious, let's say, in connecting with maybe an investor that might not be in your geo but might be interested in your space. So if you're a Boston person running a SaaS kind of company, maybe you make the leap and reach out to some Seattle enterprise investors as well, in addition to looking in your own community.
Yeah. And Serena, I'm going to ask you the next question about investor quality. How when some company is looking at a possible investor, particularly an angel or an angel fund investor, or an accelerator that they think might be a match to them, how should they learn more about the quality of the investor for their company?
Well, that just goes back to doing the homework, and that is such an important thing. It's so important to get the right investors around the table. And one of the ways you do the homework on that is, let's say if I'm talking to you and you're like, is she somebody that'd be worth having on our team, like as an advisor? Go talk to the other companies I've advised, right? Get to know the other startups I've been involved with and ask them questions about me. Ask my investing partner. I have a woman I work with here, that we're independents, but we work together all the time. It's like, talk to her. Like, everybody knows the two of us work together all the time. So you can ask her about me. It's really pretty, and you can ask, like, I work with the venture firms in Seattle. I work with all the angels in Seattle. So if you do your homework, especially in a smaller place like Seattle, it doesn't take that long to figure out who are the value add players in the different spaces. And it depends on what space you're in, because some people can be super helpful in one space and not so helpful in another. So do your homework. And the other thing I would say back to Ashok, that whole personal, what Ashok said, I agree with, which is that whole personal connection early on is so important. And obviously, for me, that means West Coast. Like, so if you're in Boston, I'm probably not going to invest unless I get brought in by a firm or something out there. Because I want to at least be able to get on an airplane in one day and get down and see you. Now with COVID, obviously that's gotten halted, but it's still like, I'm still only going to really invest in companies where I can at least get on an airplane and be there, do a day trip kind of thing, which is for me, the West Coast. So know your geographic preferences of your angels or your groups before you spend a ton of time talking to them.
Okay, great. I think I'm actually going to move us to just lightning questions and answers now, because we have a lot left, and I want to get at least some answers in for some of these questions. So we're going to move to the next slide, because these were some of the pre-questions that had come in. Suggestions on ways to increase the chance of receiving funding regionally in the U.S., not just in a hot spot. Ashok, I'm going to ask you this one.
So I think hot spots are changing. Cold spots becoming warm, warm to becoming hot. San Diego's one of them. So I'm from Boston. I lived in New York, did a lot of business in San Francisco. Now I'm here in San Diego, and part of that is because I think good things are happening in San Diego. So the same way that financing rounds are moving target, ecosystems are moving target too, and there are plenty of opportunities I can say firsthand in San Diego. Even compared to other bigger cities. So I think the key is to focus on who are the ecosystem leaders in your community, whatever that community is. I think entrepreneurship and innovation has been, kind of democratized enough in this country that there are tech ecosystems in pretty much, every city that I've been to, including some really small ones. So if you focus on building those local relationships, for starters, you probably can get the initial support that you need, maybe not to IPO, but to at least get that seed round done and get you to, the next stage of your company's development.
Great, thanks. June, is there a centralized database for researchers and university leaders to quickly scan to find the best accelerator for a particular vehicle? Do you know something like that would be helpful to people?
Somebody should definitely make that. I think probably the most comprehensive would AngelList. They actually do have a accelerator section, so that they'll list a bunch there. I think Crunchbase is a great place to look at existing companies and who their investments are and who investors are, and so you can kind of route through that. I did actually just come across a really great database of VCs in the biotech space, and I'm trying to find it in my emails right now, so I'll drop that in the chat as soon as I find that.
Great, thanks. Serena, I'm going to ask you one that's not on here. How common are NDAs in pre-seed and seed investor meetings? Is it too early for that?
NDAs, you said?
NDAs, yeah, CDAs, confidentiality agreements.
I almost never sign them. Occasionally somebody will ask if it's like, I'm in a couple of VR companies that are like really hardcore deep tech kind of stuff. Where they ask for NDAs. They're not super common though. And so I think it totally depends on, are you something that's deep tech that's going to be totally patent driven, but maybe you haven't done your patents yet and you have to be really careful, or not. The thing is pretty much almost everything. There's always 10 other people doing it as well. So people often think, oh, I've got something so unique. And the reality is it's probably not. It's going to be more about how you execute. So I don't see NDAs very often, to be honest. But I want to go back and say one more thing about where you find this database for researchers and university leaders, because that's a great question. One of the places is in the tech transfer offices. Most of the one I know, of course, with Kirsten is Michigan, University of Michigan, and Detroit's not a hotspot. Ann Arbor's not a hotspot for funding. They got huge deficits in funding there, but their tech transfer office is amazing. They have an accelerator program. They've got lab space. They've got EIRs. They've got all kinds of mentors who mentor companies. And so if you're a part of a university ecosystem or near one in your regional area, those tech transfer offices in many of those universities are very, very helpful to startups. And if you're not talking to them already, you should be.
Yeah, and I just emphasize there that if you're trying to raise money and you're in a second or third, let's say, size market, and you're finding it's really hard, you're right, it is very hard. But guess what? It's hard to raise money in San Francisco and New York and Boston and Austin and Seattle and all those other places too. In fact, it can be even harder because it might be more competitive. So the reality is when you go to the numbers and how many startups actually raise venture type funding, it's a fraction of the total startup universe. So it is going to be hard no matter where you are. Taking advantage of local resources should be the lowest hanging fruit, in your fundraising strategy.
All right, we have another question about demo days. Do you attend demo days? And Ashok, I'm going to ask this one of you. Do you attend demo days of university startup accelerators or other demo days at academic institutions? Are they? Do you find that they've produced deal flow for you?
Yes, I attend some, I help create some. I mean, it's just another platform for getting, access and connecting with startups. Sometimes it's me, sometimes it's my colleagues. We don't always attend the same ones, all the time. So we may, kind of circulate, just based on scheduling. But I think they are one platform for learning about startups. And it's not the only place. Even within those accelerators and incubators, you can also do mentoring office hours and go and do workshops and presentations to achieve the same goal, which is learning about and connecting with the startups that are part of that program. But demo days is one of the touch points that's fairly structured for achieving that end.
Thanks, that's helpful. June, are you or any of the accelerators, incubators, or other angels investing in COVID opportunities?
Absolutely. We did invest in put $2 million into COVID opportunities in April. At the moment now, as vaccines are kind of underway and stuff, we have not been putting additional money into that, but definitely thinking about how do we mitigate the next pandemic.
And as we're going through these last questions, we do have a survey that just popped up in your chat box for anyone who's still on. Actually, we still have a very large audience for these last couple of minutes. So we do have a survey. It'll also, I think, pop up when you close out from this. A couple more questions. And I like this one a lot. It's really interesting. Serena, do angels shy away from certain investments that pose too little risks due to missions to support riskier investments? Do you tend to focus on the more riskier ones? Or is it nice to see something maybe that's less risky?
I'm not sure how to answer that because frankly, everything early stage is really high risk.
Yeah.
Now some things can be higher risk than others, of course, and one way I think about higher risk is I think about how much money are they going to need to raise in order to get to a Series A and take off. So for example, VR, like some early stage VR stuff, you had to build hardware in order to prove the software. The software was the interesting part, but the hardware was the launch platform. Well, hardware is expensive, right? So it's higher risk because they're going to have to raise a lot more money to get there. So, yeah, some investments are higher risk than others. I think about that, but I'm not like looking for low risk investments. I mean, I consider everything early stage high risk. It's just the nature of this asset class.
Yeah. And we are pretty much out of time now. We have just a few seconds left. I want to thank you all so much. We didn't get to all the questions. And so what I'm planning on doing actually is we'll put these questions together that we didn't get to yet and send them to you and just have you each provide a little opinion on your answers to that so that we can follow up with the attendees about the answers to these particular questions. I'm so thrilled that we had so many questions. Thank you all. Thank you, June, Serena, Ashok, for providing your input today. I think you gave an incredible amount of information. It seems like we could have gone on for another hour and a half. Your email addresses are being provided here. Thank you so much for providing those to our audience in case they do have follow-up questions for you as well. But thank you. This has been a really fantastic panel. Thank you for providing your insights today. And then I would also like to thank our audience for joining us. I know that this has been, and for sticking with us for a full hour and a half today. So everyone take care, be safe, and we'll see you on our next webinar.
Thank you, Kirsten.
Thank you.
Thank you.
Thank you all. Great questions. I
Bye.
just answered a few more lightning round style.
Yes.
Thanks. Pardon my brevity.
Thank you.
Bye. Thank you all.